All right, let's dive right in. McDonald's just dropped its Q3 earnings, and we're going to break down what it really means for you as an investor.
So, the big question on everyone's mind, are these latest numbers a clear buy signal? Well, the top-line figures look pretty good, but the real story, it's always a little more complicated. So let's cut right to the chase with the 3 takeaways you absolutely need to know from this report. Okay, here's the whole story in a nutshell. First, global is on fire. Their international markets are really carrying the team right now. Second, that digital loyalty program, it's an absolute beast, driving a huge chunk of sales. And third, and this is the one to watch, the US market is looking a little sluggish. Yeah, it's growing, but how it's growing is what we need to pay attention to.
All right, let's dig into the evidence. Section 1, the headline numbers. First up, we've got a 3.6% jump in global comparable sales. That's a pretty healthy number, especially when you consider they're coming off a negative comparison from last year. This shows some real positive momentum.
And get this, more than $36 billion in global system-wide sales for just one quarter. That's a 6% increase in constant currency. It just goes to show you the unbelievable scale of this operation. The Golden Arches are a global powerhouse, no question.
Now this is where it gets really interesting for us as investors. $9 billion. That's how much came just from their loyalty members this quarter. Think about that for a second. That's not just a one-off purchase, that is an increasingly predictable high-frequency revenue stream. It's their digital moat, and it's getting wider every quarter.
So, how did they pull this off? Let's get into management's Accelerating the Arches strategy.
The CEO, Chris Kempczinski, said it himself. He basically said, look, we grew sales even in a challenging environment. What he's really saying is that their operational playbook is working, even when the economy is tough. And this is that playbook. It's a pretty straightforward 3-part plan. First, keep it affordable. In this economy, value is absolutely king. Second, innovate the menu, but stick to the classics that people love. And third, you gotta have killer marketing to get people in the door. Simple stuff, but their execution is top-notch.
Okay, Section 3. Now we're going to peel back the onion a little and see where that growth is really coming from. Because spoiler alert, it is not the same everywhere.
And here it is, plain as day. Look at this chart. The US is chugging along at 2.4%. But just look at international, 4.3%, 4.7%. I mean, it's not even close. The international business is the engine of this train right now, no doubt about it.
And here's the real kicker. How are they getting that growth? In the US, the report says it's primarily from a higher average check. You know what that means? Higher prices, not necessarily more people walking in the door. Meanwhile, internationally, a totally different story. That's real organic growth from strong performance in key countries. So what's next? Let's look at the company's outlook and, maybe more importantly, the risks you got to keep on your radar.
Well, management sounds pretty confident. They're planning to open nearly 1,800 net new restaurants. And that operating margin, in the mid to high 40% range, that's incredibly strong. It tells you they feel very, very good about their business model and their profitability.
But they're not hiding from the challenges. They tell you straight up what to watch for. Can they keep executing their plan perfectly? The competition out there is absolutely brutal. Consumer tastes can change on a dime. And of course, they have to protect that iconic brand. These are the headwinds.
Okay, let's land the plane. Section 5, what is the final word for you, the investor?
So here's the real bottom line. The headline numbers look good, but that's because the fantastic performance overseas is masking a much softer US market. A market that's growing from price hikes, not from more customers. And as a serious investor, that's a yellow flag you just can't ignore.
And this is the strategic tightrope that management has to walk now. How do you get more people to actually come into the restaurants in your biggest market without just jacking up prices? And how do you do that while making sure you don't mess up the amazing momentum you've got going overseas? It is a serious balancing act.
So I'll leave you with this final thought, because it's the question that's really going to move the stock price. Can McDonald's figure out how to get US traffic growing again? Or is this company going to become more and more dependent on its international powerhouses to deliver the growth we're all looking for? The answer to that will tell you a whole lot about where the stock is headed.